Hi, I'm George Pino with Commercial Brokers International, and I got a video you don't want to miss today. If you've ever invested in commercial real estate or are thinking about investing in commercial real estate, I'm sitting here today with Travis Tapp from our office, and we're going over questions his clients have asked him about what type of investments are best for their use, are there alternatives, and what kind of investment horizon should they be looking for? So don't miss this one. I think there's a lot of great insight in it. I look forward to hearing from you, and all of our contact information will be posted down below. Hi, I'm George Pino, CEO of Commercial Brokers International. I'm sitting here with Travis Tapp. He's one of our agents, and actually, one of his clients had come to him and they were talking a little bit about different types of investments, and he wanted to kind of discuss that with me a little bit. And I thought this might be a good video for everybody to watch. So, Travis, can you tell me a little bit about your client and what they're looking for?
Yeah, so I typically deal with multifamily owners, as you know, and kind of where things are going right now. A lot of them are getting a little scared of returning to multifamily, and I'm getting asked specifically on this one client to switch over to a different asset class, but they're a little scared. It doesn't feel like familiar waters to them.
Sure. Okay. Well, understandable. I mean, people tend to be afraid of things that they may not have much knowledge about. So I think, the key is education. I think that almost answered itself in a way, but it's a matter of really defining what type of education. And let's actually step back a little bit as an investment. And I would initially, if someone were to talk to me about alternative forms of investment, I would actually ask them, well, what were your original goals when you bought this property? What were you trying to accomplish? And has that changed? And are you looking to do something else down the road? What are your goals now with any investment? And from there, we're going to then determine whether or not the current investment that they have meets those goals or will meet those goals. And if not, is there an alternative investment that might do better for them in better returns, better maybe asset preservation, maybe a hedge against inflation? And, there are different types of assets, different types of properties that all can play into that type of factor. And once you find out from there, now it's a matter of education. So
very true. My the specific client, and this is becoming more common and more common, is they want security right now. And I'm bringing them up single tenant, triple net leases, and which a lot of them are slightly familiar, but the main reason that I get that they're so concerned about switching from multifamily to there is appreciation, and they feel that they're not going to get that with STNLs.
Well, I think they're not looking at it the right way.
Okay.
So, in addition to cash flow, you have appreciation as well as debt service that might go all into the overall return of the property, which then you can generate from an IRR, internal rate of return. So, number one, and I'm not saying this is the case, but even if a property didn't appreciate, if the cash flow is high enough, it still may be better than another property that appreciates but doesn't have as good of a cash flow. Money today is worth more than money tomorrow.
Very true. Very true.
So that's something to take into consideration. I have investments myself that are strictly cash flow plays, but I'm getting a good 15% return on them. They don't appreciate that much at all.
But because of the higher cash flow?
But because of the higher cash flow, I'm doing just as well as if I held on to some other properties long term.
Okay.
So, and in fact, I like to think I'm doing better because now I actually have cash that I can in hand because I have higher cash flow that I can use for other investments. So, I think there's different types of properties that can fit that criteria. So you have to take a look at, is the property appreciable? Will it appreciate? And how is it going to appreciate? So any kind of investment that you're going to go into, if it's a single tenant net lease and you're looking for appreciation as part of your return, then you're going to look for strong areas and neighborhoods that are growing populations where rents are going to increase, and that creates that appreciation. You can go in and take a look at a lot of these properties or re-tenanting potentially. Down the road, what is this property? Is it such a great location? As I like to say, I am, when it comes to my own investments and also working with clients, I'm geographically agnostic, but extremely location driven. Okay. So, almost any town, maybe not a couple I can think of, but most towns or cities will have an area or that is the best area. And, if you look
Best
at that,
as in more populated, higher traffic counts, or
exactly all of that actually.
okay.
Traffic generators. It might be next to the city hall or the local college or university. University towns. This was something I learned when I was in my 20s. I of course made a snap judgment. I saw a property one time and saw it was in Arkansas, and I thought, Arkansas, nothing appreciates in Arkansas. There's no really good properties in Arkansas. Didn't even look at it, and then came back to it later and was like, oh my God, the property is directly outside the front entrance to the University of Arkansas. They're never going to go out in Bentonville. So to me, that was an irreplaceable location that, it's one of those that's going to appreciate in time.
Yeah.
It's always going to be there. Those type of locations are what I try and go after with my own investments as well as with clients I'm working with. I do have some clients, though, that just want straight cash flow, and they'll trade that for maybe a Dollar General in a tertiary market, with the understanding that they're not going to get that appreciation down the road, but they're going to have much higher cash flow, potentially anywhere from 30 to 50% higher than if they were to purchase something in a better location. And there's also risk involved as far as if you just purchase on cap rate, you may end up getting a property that down the road, you're going to have to reduce the price just to keep that tenant in place. So it's all about location to me. When I say about location, just what you said earlier.
Yeah.
Traffic counts, traffic generators, population, growth population, income demographics, 1, 3, 5 mile radius, what's going on in that community.
And now that we're talking about location, one thing that I feel like a lot of these investors, multifamily owners, they all kind of have the same concern, which is how am I going to feel comfortable and or confident to buy a property in a city or even a state that I've never been to? Well,
here's the nice part is that, again, depending on the asset class, if I'm buying out of state, honestly, I wouldn't necessarily buy multifamily or office or much, a lot of stuff that may need my own supervision or management. I prefer going for most of my investments that are out of state, single tenant net lease, because the tenant themselves takes care of the maintenance, the repairs, the property taxes, the insurance, and they show proof of that every year, sending it back to you. Some people always ask me, how do we know we're going to do this? The beautiful part about most single tenant net lease assets is that they are retail assets. And as retailers, they're very much co-aligned with keeping the appearance of the property up, just to bring in their own traffic. So they're co-aligned with my goals as well.
Okay.
We both want a clean property. We both want one that's nice. We both want one that's updated as much as possible. And in fact, I've had tenants put $300,000-$400,000 into a refurbishment on a property that only had a few years remaining on the lease, because they realized that investment increased their business. So they actually improved my property at the same time, and it was a win-win for everybody.
So if you buy a property that is, say, on the other side of the country, how often would you personally go and check it out? Or would you just make a phone call, send an email? Or is that something that's just out of sight, out of mind, collect the checks?
Combination.
Okay, fair enough.
I like where you're going with this. You're kind of covering all the bases with that. If I'm investing out of town, if it's a multifamily type property, which I haven't purchased multifamily properties out of the state, I am there at least once a month just to have eyeballs on that property, just to see what's going on. Make sure the property manager is doing what they're supposed to be doing. The multifamily, the tenants typically are not co-aligned with the landlord in maintenance and upkeep with the building.
That seems to be very accurate.
They look at it as, hey, the landlord's giving me this, so they're supposed to do everything, even if they're at fault.
Yeah.
So, because of that, I want to be there to make sure it's getting taken care of, making sure that the property's being serviced. If it's a single tenant net lease building, generally speaking, I go out once every 6 months or so, but at the same time, I tend to buy properties in areas that I travel as well. So, part of my trip can be part of a tax write-off for visiting my investment, making sure they're maintaining it.
Yeah.
So if I weren't in it, like, let's say I have an area or purchase a property that's a great property and it's not necessarily an area I would travel to,
Yeah.
I'd still probably make it a once a year trip just to make sure that they're maintaining it, that they are doing what they're supposed to do.
Just in case you want to reposition it later down the road, if they're thinking of leaving.
Seeing also what's going on in the community, what's happening, what's in the area itself. Everybody should be, whether your investment is a duplex or a 50-unit apartment building, a 200-unit apartment building, a single tenant net lease, a retail strip center, whatever the real estate investment is, everybody should at least once a year reevaluate the performance of that investment, and is it doing what you set out to do? And if not, how can I redo it? Or your exit strategy. Your exit strategy may be XYZ, but due to changing demographics and population growth, it may be now something else. So understanding where you are in your investment and how you're going to exit out of it is key, and that should be done on a yearly basis. So that's why we go out at least once a year.
And I think exit is very key, and the strategy is most important, especially heading towards where we're heading now. How would you say, as far as in a timeline, how far back would you say you need to start preparing to exit your current asset class into a new one?
Are you looking at, well, I always like to say also with commercial investments that any investment horizon or investment period that is, 3 years or less, you're really more speculating, versus actually creating an investment type. You're hoping the market's going to stay the way it is and how it's going to go. 3 years is kind of a short term for a commercial property to change out tenancies and increase rents and do what you can to create that appreciation. So instead, now there are certain types of properties that are high risk that you can target for that. Like meaning a single tenant net lease that is under market rent that has a short term lease on it with no options.
Okay,
so
that is pretty high risk.
It's high risk. Granted, the tenant, if they're doing well, will likely want to stay. It may not be the best choice, but you might be able to have bumps up there. And I've had clients that have done extremely well with, getting in a 2 year period, multiples of their investment. 3x multiples on their investment, just in two or 3 years. So you can do this and reposition them very well and create that value as well. But you have to understand what the market is and where it's going to do that. So, again, just comes down to where we're at time frame wise. If I were to purchase today, given everything going on with the economy and political climate, as well as elections coming up in not just in a couple weeks, but also in a couple years for the presidential elections, I would probably hazard. I would not look at an investment that is less than 5 years for myself.
I think that's
5 year hold.
Yeah.
And realistically speaking, I think that we're probably looking at a 7 to 8 year hold period right now. Given that, I think I think the economy is going to stabilize. We're not going to necessarily go into a deep recession, but right now we are. People, until we can get the interest rates and the pricing get settled and kind of get a little bit more stabilized ground on where we're looking. There's a lot of uncertainty in the investment market. So because of that, people have pulled back. You have a lot of sellers that are putting properties on the market thinking that if I don't sell now, it's going to crash. Meantime, you have a lot of buyers that are sitting there going, well, let's see what happens with the sellers if they don't sell them.
Well, I think we're getting a lot of that on both sides.
Absolutely.
And I think, if anything, what do you have to say to investors on either side that, they keep saying, well, I'm just going to sit back and wait. I'm just going to sit back and wait, kind of see what happens. I mean, I know what you told me in the past, but what do you think as of now?
Two things. I can only talk about my own past experience and with clients as well as personal experience. I feel that it is, you can be in the market and judge it fairly well with good historical background and understanding of what's going on, both on the macroeconomic level as well as microeconomic level. That being said, nobody has a crystal ball.
Very true.
We don't know where it's going to go and how it's going to go. How many opportunities might you miss? There's no reason to hope for the future that things might change when you have an investment and a potential investment that you can make now.
Mm-hmm.
And as long as it meets the criteria and meets your investment goals and what you're trying to accomplish and gives you the return you're looking for, there's no reason to wait at that point, because waiting, we don't know if it's going to get better. We don't know if it's going to get worse. And there might be more opportunities. So that's what I always tell my clients. It's like, don't try and time the market, but rather look at the investment.
And also, I think going back to what we were originally talking about, now is a good time to, if that's what you're thinking, maybe consider switching asset classes.
Absolutely, because if you're looking at high inflationary periods and you're expecting that, there are certain types of asset classes that protect you from that. You have, again, going back to single tenant net lease and multifamily, both of them are considered good hedges against inflation.
Yes.
Multifamily, because as interest rates rise and we go into a slowing economy, less people can afford to purchase houses, so that has to go into the rent. They have to go into the rental market, which stimulates some basic supply and demand. You can then increase your rents. That's great if you live in an area that has completely free ability to raise rents.
Correct.
If you're in an area that may have rent control, certain states, certain cities, that can very much limit it. And in fact, you could actually end up losing money, because think of it this way. A multifamily owner, yes, they can raise the rents 3, 5, 10% potentially, if it's depending on where, and if they're not in a rent control area. But let's say if you are in a rent control area, let's say it's historically been a 3% rent increase. That sounds okay when you're like, okay, well, at least I can raise it 3%. The problem is you're also paying for all those expenses.
And every year. And
when we have inflationary rates that are 8 to 10%, your expense growth and cost is going to outweigh. It's going to outpace your income growth.
Yep.
So if anything, you're actually returning less and you're doing not as well. So a single tenant net lease, where a tenant pays for all the property taxes, the maintenance, insurance,
all of it,
all the expenses, you're insulated from that. You don't get the 3% annual growth. It may be 2%, 10% every 5 years. But that is actually, if you look at the fact that they're not paying increases in expenses, it actually works out better than the 3% growth. So,
and during inflation, it seems like it might be a little bit safer.
If the lease term is long and you have a good credit tenant, absolutely.
Yeah.
Absolutely. That's one of the reasons why they can be considered such a good hedge against inflation, that weathers the downturn in the economy, especially, if I have McDonald's guaranteeing the lease. One, they tend to be a typical recession-proof tenant, but even if the location doesn't do well, they're still paying rent to me, at least during that lease term, and then I can reposition and get out of it when the economy picks up again. But I know during that time, I'm not going to have to worry about that rent at all during a down period, during recessionary times, as opposed to I have a vacancy or, trying to get somebody in for residential or even a strip center or office. In a recessionary period, that takes longer and it costs more money and it's harder to do. So, those offset also,
and that's how
some of the income.
And I think that's what's important, having a good broker behind you, because not all single tenant net leases are the same.
Not at all.
No, if one costs the same amount but is netting more, that doesn't necessarily mean it's going to be the better deal.
Yeah. No, my team and I, we typically we look at probably close to 100 plus properties a day, and we find maybe a half dozen that we like, that are worthwhile sending to our clients. And
that's crucial. That's crucial.
It's crucial to be able to have someone that can help you with that. But more importantly, it's understanding the different types of investment and, what is best for them. I mean, I've had people who thought they wanted to invest in single tenant net lease, and after talking to them, I said, well, for what you're trying to accomplish, a multifamily may be a better asset. Let me put you in direct contact with my multifamily agent. Or if it's a different area, it might be something else.
And yeah, that is very important to have at least faith, trust in a good broker, and know exactly where they're going and how to point you in the right direction. Because a lot of buyers and investors, they get stuck on the NOI, the net operating income, and they think the higher that is and the less the price up front, that might be the best bet because they're spending less.
Absolutely.
What they can kind of get in a little bit of trouble here soon down the road if they don't look at all the logistics, though, I think is what you're saying.
Absolutely. Well, all the logistics, all the everything that goes into it's basically the real estate fundamentals. Just getting back to those, taking a look at what drives the pricing on those properties, how is it going to affect it, and then figuring out whether or not that's really the best investment for them. And getting back to your question that we started off with is, how, what do I say to a client that is considering looking at a different asset class? What can I put in front of them? Ultimately, I wouldn't ask them initially. I'd actually find out what they're trying to accomplish and then realize that there are different types of properties that may accomplish those goals, some better than others, and then feeling what their comfort level is to then make that switch and move forward. But I think, if you use that education, and you put together spreadsheets and show them what they can do with different formats and different types of investments, they're making an informed decision. But it also allows you another point of contact with your client. If you have a client that you sold a property to that's a multifamily property a few years ago, you might want to actually give them a call and say, hey, I thought I'd check to see how your investment's doing. What do you think about it? What do you like? Is it still meeting your goals and expectations? And open that conversation. Say, if this is what you're still looking to do, there might be some better alternatives. Let me look. But if not, let's stay the course. And, it's not really sales, but you're really adding value because you're giving input into their investments, which most people don't think about once they make it.
Yeah. Yep. Yeah, very true. And on the agent side of things, because I know I've made this same mistake, is you have to be aware of how the financing can change from asset class to asset class.
Absolutely.
Because I've stuck my foot in my mouth plenty of times when I've had multifamily owners that are attempting to switch to a different asset class. And then I have to down the road say, because I wasn't thinking, I'm so used to multifamily. I start thinking STNL. I'm not thinking they need more than 30% down, sometimes even as 50% down for the most part, and I have to break it down to these multifamily owners that weren't necessarily ready to put up that much of a down payment. And I think that's another important part of being educated in all asset classes, having faith in your broker.
Well, absolutely. Understanding everything that's going on in the marketplace and explaining that over to them. It's your loan situation. Here's what we're doing. Here's what inspections we're going to need. Here's the whole process. I'm going to walk you through it. I'm going to hold your hand all the way across the finish line. But these are what you can expect.
You have to set the right expectations.
If you set those expectations and those expectations match what they're trying to accomplish, they're going to fall right in line with you and work with you to increase their returns.
And hopefully be as smooth as it can get in real estate walking the park.
As smooth as it can get walking, I've stumbled a few times in a park. So, as smooth as it can get in commercial real estate, especially in these kind of bumpy times. So, ultimately, I think if anything, you're doing your client a service by asking these questions.
Absolutely.
Because these are a lot of times the questions that they don't ask themselves.
Absolutely. Well, George, thank you for answering all these questions. I know everyone is going to be really appreciative of knowing well more beyond about all these other asset classes. And absolutely.
Well, thanks for actually setting this up and coming in and asking. It's
of course.
Talking about this. It's I think this is an important part of investing that a lot of people don't take a look at.
Yep.
Okay.
All right.